Hi friends, Simit here from InformedTrades.com. In this video, I want to talk about a simple Forex strategy that I use based on long-term fundamentals, using some simple metrics to gauge long-term fundamentals and then some basic technical analysis to help us time the trades. This is a strategy and one of a number. I'll do some more videos on strategies like this that I think are fairly straightforward and it'll be conducive towards a lot of people just starting out implementing. Okay, the key points in this strategy, we want to limit ourselves to 9 currencies. We can ignore everything else, start with a relatively small data set. Sort those 9 currencies by interest rates, then by their external debt to GDP ratio. That'll tell us what currencies to trade and what direction to trade them. Then we time that with some straightforward support and resistance analysis on the chart. Okay, currencies with enough volume. These are the 9 currencies we'll limit ourselves to. US dollar, Australian dollar, Canadian dollar, euro, Japanese yen, New Zealand dollar, British pound, Swiss franc, Singapore dollar. We can ignore everything else. These 9 currencies have significant trading volume or sufficient trading volume where chart patterns will hold up and work out reasonably well. And the spreads will also be sufficiently low so that the cost of trading is pretty low as well. Okay, once we have our 9 currencies identified, we want to sort them by interest rates. If you simply search the web for Forex interest rates, you'll find this information pretty quickly. We'll also have it posted on informedtrades.com in case you ever want to discuss it. Here, right now, we see Australian dollar and New Zealand dollar stick out. And Canadian dollar. These three are the only ones that are 1% or higher, Australia being the highest at 3%. Everyone else is pretty low, below 1%, 0.1% for the yen, for instance. And our bias here is we want to short the currencies with the lower interest rates, and we want to go long currencies with the higher interest rates. That's our initial bias based on what the interest rates are telling us. Okay, next thing we look at is external debt to GDP. Here, basically, external debt to GDP is countries or the government of a country's debt held externally, held by foreign creditors, and we measure that relative to GDP. If that amount is high, if there's a lot of external debt relative to the GDP, the economic productivity of the country, the currency is susceptible to foreigners, dumping it. And historically, that's been one of the catalysts for a hyperinflationary episode. Foreigners abandoning a currency, and its value drops precipitously. Here, this information or this chart, which comes from Wikipedia, Luxembourg is really off the charts here, but United Kingdom is pretty high, and Australia is relatively low. With this data and with the interest rate data, we want to keep in mind where we also think it's headed. So, this reflects the current information, but it may help to observe the news. What are the central banks saying? What are the monetary authorities saying? In both instances, the United Kingdom seems pretty committed to its path of deficit spending. Australia seems a little more hawkish. So here we have a clear example setting up. Going back to the interest rate chart, Australia's got a much higher interest rate. The United Kingdom has a pretty low interest rate, so that tells us we can be bullish on Australia relative to the British pound. And the external debt to GDP ratio confirms that analysis. So that gives us our trading direction, our trade. We want to look to short the British pound relative to the Australian dollar on a sufficiently long time frame, believing that, in the long term, this is where capital flow around the world sort of has to go based on what the fundamentals are saying. Now, when it comes to timing that trade, we use simple support resistance analysis. So we can just, look at trading ranges. Here's a monthly chart, pound British Australian dollars. We're speculating that this chart's going to keep falling. We see a trading range here. Anytime we see a trading range, we can just enter a short position with our stop right above the trading range. So it may not have worked out well in this particular instance. We entered here, we might have gotten stopped out here. But the market also forms a trading range here, and we get a long wick through the trading range. It's a great sign, which means that price briefly stepped through it, but then sellers came and pushed it right back down. So this is also an entry signal. And we can exit when there's another range forming. So market forms a range here. That might be our time to exit. Maybe people are taking profits. Maybe market's going to rise and it forms another trading range. That could be another opportunity to exit, to enter and trade it. So that's the basic trading strategy in a nutshell. It can get a lot more sophisticated, once you really know your technical analysis and money management well. But this is a simple introduction to help you get started. If you have any questions, join us at informedtrades.com.